Most people are trying to turn $20,000 into a new car in 3 years. That is why they stay poor. I was interested in turning 20,000 into 400,000 over 30 years. That is why I died rich. If that sentence offends you, good. That means you still have a chance. The world will sell you a fantasy of getting rich fast. I'm going to explain how to get rich slowly, which is the only method that actually works for almost everyone. It is boring, it is repetitive, and it is brutally effective. It also requires you to stop doing almost everything that comes naturally to you with money. Start with a simple fact. If you turn $20,000 into $400,000 in 30 years, you have multiplied your starting capital by 20. That sounds impressive. It is not magic. It is arithmetic and behavior. About 10% a year for 30 years gets you there. The math is not hard. Living with that math is what destroys people. People do not fail at money because they cannot multiply. They fail because they cannot wait. The average person in their 20s or 30s today lives like this. They earn a paycheck. They spend almost all of it. They keep maybe a few percent in a savings account, earning close to nothing. And they dream about some breakthrough that will bail them out later. A promotion, a jackpot stock, a business that magically works despite no discipline. That is not a plan. That is a prayer. I have watched this for almost a century. The pattern does not change. A person in their mid-20s gets a bit of money together, maybe an inheritance, maybe a bonus. Maybe they manage not to waste all of their pay for a few years, and they accumulate $20,000. This is the moment that decides the next 30 years. Most people start thinking, I deserve something. I have been working hard. Life is short. I will take a trip. I will get a nicer car. I will upgrade my apartment. The 20,000 evaporates into a slightly nicer but completely forgettable lifestyle. 5 years later, there is nothing to show for it except old photos, worn-out furniture, and more fixed expenses. Then there is the smaller group that says, I will invest it. That sounds intelligent. Then they behave like idiots. They chase hot stocks. They subscribe to tips. They buy things they do not understand because some loud stranger promised big returns. They jump in and out of the market based on headlines and emotions. 10 years later, they have turned 20,000 into 23,000. After inflation, that is less than they started with. The problem is not knowledge. The basic principles of wealth building are not complicated. The problem is temperament. People cannot stand the idea that real wealth is built over decades, not weekends. You want to know how to turn 20,000 into 400,000 in 30 years. I will give you the simple version first, because you will resist it, and then I will walk you through why your brain fights what works. Here is the simple version. You save real money early, you put it into productive assets at a sensible price, you avoid stupid behavior, you let compounding work, you keep adding, and you do this for 30 years without quitting. If you want a more exotic formula than that, you are in love with fantasy. Let us talk numbers, because numbers do not care about your feelings. If you invest $20,000 and earn 10% per year, after 30 years you will have about $340,000. Add a bit more every year, even a few thousand, and 400,000 is not ambitious. It is conservative. 10% does not require genius. Stock market indexes over long periods have done around that, sometimes higher, sometimes lower, depending on the era. A concentrated portfolio of good businesses bought at fair prices can do that or better. What it absolutely requires is that you do not keep interrupting the compounding machine every time you get bored, scared, or greedy. Imagine a snowball rolling down a long hill. That is your capital. In the early part of the hill, the snowball looks pathetic, small, unimpressive, not worth bragging about. That is the first 10 years of your investing life. Everybody wants the last 10 years of the snowball, and almost nobody wants the first 10 years. So they never get to the last 10. In your 20s and early 30s, the dollar amounts look small. You save $300 a month, you invest it, and at the end of the year, you see a gain of $300 or $400. You yawn. Then you look at a cryptocurrency that doubled in 6 months and you begin thinking you are an idiot for being patient. Soon after that, you actually become an idiot because you throw away the boring compounding machine and chase fireworks. People love fireworks. They go up fast and explode. Fireworks are not a wealth-building strategy. Here is what almost no one tells you when you are young. In the beginning, the compounding is not about the returns. It is about training your character. You are not only building capital, you are building the ability to sit still while the world tries to provoke you into doing something dumb. I had to train myself to do nothing when doing nothing was correct. Most people never learn that. They think action is always superior to inaction. In gambling, constant action is what the casino wants. In intelligent investing, constant action is almost always a tax on your future. You want to turn 20,000 into 400,000 in 30 years. You will not do that by being busy with your money. You will do it by getting a few big things right and then avoiding disaster. Let us look at the first big thing, the starting capital. Most people never even get to the starting line. They talk about investing, but they never actually accumulate the 20,000 in the first place. Why? Because spending has become their comfort drug. Whenever they feel bored, stressed, or insecure, they anesthetize themselves with consumption. They call it treating myself. I call it self-sabotage disguised as self-care. To get 20,000 together, you need to live below your means for some years. That is how every serious fortune begins. Not with a trading strategy, with a gap between what you earn and what you spend. A young person earning 40,000 a year who consistently saves 6,000 or 7,000 can reach 20,000 in 3 or 4 years. That same person going out to restaurants 3 nights a week, financing a shiny car and upgrading phones every year will still be complaining about never getting ahead in a decade. You cannot compound what you never saved. The first brutal truth is that wealth is a habit of underconsumption long before it is a skill of investment. Once you have the capital, the question becomes, where do you put it? Most people leap straight into the most complicated answer they can find. Options, leverage, exotic instruments. They assume complexity equals sophistication. That is backward. In real life, simplicity is usually a sign of understanding. My approach for someone who wants to grow 20,000 over 30 years is plain. Buy pieces of real businesses that produce cash, have durable advantages, are run by competent and honest people, and are not grotesquely overpriced. Then hold on to them as long as the business remains sound and the price is not insane. If you cannot pick individual businesses sensibly, you buy a broad, low-cost basket of them, something that owns many companies, charges you very little, and does not pretend to be clever. People hate this advice because it removes the fantasy of being a genius. They want to believe they will discover the next great stock just before everyone else. They confuse the lottery ticket mentality with investing. I spent decades watching markets, and I did very well. And even I do not rely on finding the next big thing. I rely on not doing dumb things with obvious opportunities. The critical lever is time. Time plus return equals result. But time also equals temptation. The longer the path, the more chances you have to blow yourself up. Let us walk through a real 30-year path in your mind, because that is where the battle is. Year 1, you invest your 20,000. You have read some basics. You feel responsible. The market goes down 15%. Your 20,000 becomes 17,000. You feel stupid. Your relatives make jokes. You think, I knew this was risky. If you are like the majority, you bail out right there, lock in the loss, and tell yourself investing is a scam. You never reach year 2. If you are slightly less foolish, you hold year 2. The market recovers. You are back around 20,000, maybe a bit more. You feel relief, not conviction. You still do not really understand what you own. You are just less scared than in year 1. By year 5, if you have stayed put and continued adding some money, you may have 30 or 40,000. Then comes some crisis, a recession, bad headlines, a 25% drop. Now your account falls 10,000 in a few months. The numbers finally feel real. Your brain screams, do something. All your instincts tell you to run. This is where character decides your future net worth. The person who panics here destroys 10 or 15 years of eventual compounding. The person who understands that productive assets go through storms and that prices fluctuate while value does not, that person tightens their belt, holds, maybe even buys more if they can. 30 years later, the gap between those two decisions is enormous. You do not earn 10% a year by getting 10% every year. You earn 10% a year by enduring a lot of years that look terrible, some years that look wonderful, and a long string of very boring years in between. Most people are not defeated by the terrible years. They are defeated by the boredom. Boredom is underrated as a financial killer. A person with 20,000 or 50,000 invested starts to think of that capital as a tool for excitement. They want the dopamine hit of a huge gain. They hear about someone who made a killing in a short time. They look at their slow but steady growth and feel like suckers. So they start gambling under the name of being more aggressive. They abandon the steady 10% for the chance at 50%. What they usually get is negative 30. I will tell you something that most of the financial world will never admit. You do not need more than a handful of good decisions in your life to do very well. What you absolutely must avoid is a few catastrophic decisions that wreck your compounding. Avoiding stupidity is more important than seeking brilliance. The screw-ups that destroy 20,000 over 30 years are predictable. Borrowing money to invest so that a bad year wipes you out instead of just hurting your ego. Buying into things you do not understand just because they are popular. Trading frequently and paying a constant tax in spreads, commissions, and mistakes. Selling good assets because they had a bad quarter. Ignoring valuations and overpaying for fashionable companies. Convincing yourself that this time is different so you can rationalize obviously reckless behavior. You do not need to avoid these 90% of the time. You need to avoid them completely. One or two of these disasters can undo 20 years of discipline. Think of your financial life like crossing a minefield. There are big rewards on the other side, but only if you do not step on anything explosive. You do not cross by sprinting, jumping around, and trying acrobatics. You cross by moving slowly, testing your steps, and following reliable maps. Now let us return to the arithmetic of turning 20,000 into 400,000. Imagine you start at age 25. 30 years takes you to 55. That is not ancient. That is many years before a typical retirement. You have given yourself time for a second and third compounding cycle after that if you wish. At 10%, 20,000 becomes about 340,000 without you adding another dime. If you add 3,000 each year, adjusted gradually, you cross 400,000. What is 3,000 a year? $250 a month. About $8 a day. The price of constantly upgrading your lifestyle is that you sacrifice the snowball so you can feel slightly more comfortable today. Let me put it in a way that stings a little. Most people are trading a retirement with $400,000 of capital for some takeout food, a nicer car, and a few weekends of entertainment. They are literally eating their future. There is nothing wrong with enjoying life. I enjoyed mine, but I did not confuse consumption with progress. You can decide what to cut. You cannot negotiate with the math of compounding. Once your capital starts to grow, something interesting happens. The money begins to work harder than you do. That is the whole point of this game. Imagine that after some years, you have 100,000 invested at 10%. That is 10,000 a year in gains on average. How long would you have to work at your job after taxes to earn that 10,000? Now imagine you reach 400,000. 10% of that is 40,000. At that point, your capital is generating roughly the entire income of a modest job. This is the change in status that most people never achieve. They remain dependent on a paycheck until they die because they never forced their younger self to build capital. They worked for money, but they never acquired money that works for them. Labor is you shoveling coal. Capital is owning the shovel factory. The person who saves early, invests sensibly, and lets compounding run gets a second worker in their life, their capital. That worker never sleeps, never gets sick, and never asks for a raise. But it demands respect and patience. You will notice something else on this path. The first 10 years are the hardest psychologically and the least impressive financially. The last 10 years are the easiest psychologically and the most impressive financially. If you behaved, this is exactly backward from how the average person expects it to feel. In years 1 through 10, you are living below your means. Your friends may be spending more, and your investment accounts look small. You feel like you are sacrificing a lot for not much reward. Your inner child complains. In years 20 through 30, the machine is doing much of the work. Your capital gains may exceed your annual savings. You are no longer climbing only by effort. The compounding is lifting you. The problem is, you do not get to years 20 through 30 if you bail out in years 3, 7, or 11. The world is very good at distracting you right before compounding gets exciting. It will offer you status symbols, tempting shortcuts, and constant fear. You will hear, the market is overvalued. This new thing will change everything. Cash is king. You are missing out. You are going to lose it all. You will be invited to join the stampede over and over. Most of the time, the correct response is to do nothing, maybe adjust slightly, maybe rebalance, but mostly sit. Sitting is not the same as being lazy. It is active discipline. You are deciding not to interrupt the process that you know works. Of course, all this only applies if you actually own something worth holding. Sitting on a bad business is not discipline. It is denial. So you must learn enough to distinguish a productive asset from a spectacle. A productive asset is something that generates cash or value from real activity. A business that sells goods or services people willingly pay for. A piece of property that collects rent from real tenants. A share of many such businesses. These things are connected to reality. A spectacle is something whose value depends mostly on the hope that someone else will pay more for it later, without any underlying productive engine. I have no interest in holding spectacles. They are hot when they are hot and brutal when they cool. They attract people who cannot stand the boredom of real wealth creation. If you want 400,000 in 30 years from 20,000, do not spend your life jumping from spectacle to spectacle. Own boring things that grind out cash. I am not telling you this because it sounds wise. I am telling you this because that is what worked for me and for my partner. We found a few outstanding businesses. We bought them at sensible prices. Then we sat for decades while they did the work. We did not constantly reinvent ourselves or chase every new fashion. People called us old-fashioned. They were right. We were old-fashioned and very rich. There is another angle most people ignore. Taxes and friction. Every time you jump in and out of investments, you incur costs. Sometimes they are visible, sometimes hidden. Fees, spreads, taxes on short-term gains. Each small bite is like a tiny rust spot on your compounding machine. Enough rust, and the machine stops working. The person who trades constantly and brags about occasional big wins is usually worse off than the quiet person who buys solid assets and rarely sells. Because the quiet person is letting the government wait decades to tax the gains. The loud trader is sending a slice of every gain to the tax authority and the broker. Quiet discipline beats noisy cleverness. If you invest 20,000 and turn it into 400,000 over 30 years with minimal selling, you have deferred taxes on most of that compounding. If you tried to optimize by jumping in and out every few months, you probably end up with half or less, even if your gross returns were similar, because you leaked money all along the way. The world is full of people who are too smart for their own good. They cannot stand a simple strategy that works because it does not feed their ego. They want something complicated so they can feel superior. They forget that the goal is not to look smart. The goal is to have money. Underneath all of this is one thing: character. You will not stick with a 30-year plan because of math alone. You will stick with it because you decide what kind of person you are. Are you the person who needs instant gratification, or can you delay it? Are you the person who must have what your friends have right now, or can you live with being slightly less flashy so you can be far more free later? Are you the person who panics when things go down, or the one who stays calm because you understand that storms are normal? You can learn to be the second type. I was not born with unusual emotional control. I just watched enough stupidity and pain to realize I did not want to end up like the average person. You might be thinking, what if I am starting later? What if I am already in my 40s or 50s? Then the lesson is even harsher. You do not have 30-year cycles to waste. But the principle is the same. Save more, spend less, avoid nonsense, buy productive assets, let them work. You may not get 20 times your money in 30 years because you may not have 30 years. You may get 3 times in 15 or 10 times in 20. That still beats staying on the hamster wheel until you collapse. People talk a lot about financial freedom. Here is my definition. You are financially free when your basic needs and some reasonable wants are funded by capital working for you, not by your labor alone. For many people, 400,000 at a decent return, combined with some continued work, moves them much closer to that condition. It is not never work again money, but it is I have options money. And options change how you sleep at night. One of the great delusions of modern life is pretending that you can separate lifestyle choices from long-term outcomes. You cannot. Every time you choose to spend rather than save, you are voting against your future compounding. Each vote is small. That is why you barely notice it. But 30 years of votes add up. You do not need to live like a monk. You do need to be honest about the trade-offs. If you buy the new car, take the luxury vacation, and constantly upgrade your living standard as your income rises, then do not act surprised when you reach middle age with nothing but memories and monthly payments. You chose that. People want wealth, and they want the appearance of wealth at the same time. That is usually impossible on an ordinary income. You must pick one. The appearance now, or the reality later. The appearance is the leased car, the branded clothes, the expensive neighborhood where everyone is secretly stressed. The reality is a growing pool of assets that generates cash, while you drive a perfectly functional but unremarkable car and live in a house that is slightly below what you could stretch to afford. The real game is played in silence. Most rich people who kept their money do not live like the caricatures you see on television. They quietly accumulated capital and refused to blow it just to impress strangers. You say you want to turn 20,000 into 400,000 in 30 years. What you are really saying is that you want to transform your relationship with time, comfort, and temptation. Here is what that path looks like in blunt terms. In your 20s and 30s, you live on less than you could. You say no to certain pleasures. You drive something reasonable. You keep your housing costs sane. You avoid debt like it is a disease, except perhaps for a modest mortgage. You save aggressively. You learn the basics of business, accounting, and investing so you do not act blind. You buy productive assets and ignore the circus. During these years, you will watch other people seem to be ahead. They will post photos. They will look successful. Some of them are deeply in debt. Some of them are spending family money. Some of them will be bankrupt at 50. You ignore that noise. In your 40s and 50s, your earlier decisions start to dominate. Your investments will be large enough that good years feel significant. A 10% gain on 400,000 is 40,000. A bad year will feel painful too. But you will realize that your destiny no longer depends solely on your salary. Capital is now in the fight with you. By the time you reach the end of the 30 years, you will have something most people never touch, a meaningful sum of money that is the product of your choices, not a miracle. You will know exactly how you got it, and that is the point. That knowledge is more valuable than the number, because once you have mastered that process, you can repeat it, scale it, or teach it. You may still wish you had started earlier. Everyone who compounds seriously feels that. I feel that. But you will not wish you had wasted more money and more time. People ask, what is the secret? As if there is some hidden door. There is no secret door. There is just arithmetic, psychology, and discipline repeated over decades. You either respect the math of compounding or you do not. You either control your impulses or your impulses control you. You either own productive assets or you rent your life to someone who does. 20,000 to 400,000 in 30 years is not an extraordinary achievement. It is what should happen for a disciplined person in a reasonably functioning economy who follows basic rules. The tragedy is that it feels extraordinary because discipline has become rare. When you finish listening to this, nothing in your life will change unless your behavior changes. Your income can stay the same. The market will do whatever it does. Interest rates will go up and down. Politicians will talk. None of that is under your control. You control how much you spend. You control how much you save. You control whether you learn enough to distinguish investing from gambling. You control whether you chase every shiny object or stick to a simple plan. You control whether you panic in downturns or stay rational. The path to 400,000 over 30 years from 20,000 is brutally simple. Save real money early. Live below your means. Avoid debt. Own productive assets. Do not pay high fees. Do not trade constantly. Do not buy what you do not understand. Sit through the storms. Keep going. Most people will not do this. They will find a reason to delay. They will wait for a better time. They will say it is too late. They will say the market is too high, or too low, or too risky, or too boring. They will find a way to avoid the one thing that actually works: sustained, boring, rational behavior. That is good news for you. Wealth, like anything else, is relative. If most people insist on losing the game, it becomes much easier to win by simply not playing like them. At the end, you must decide who you want to be. You can be the person who looks rich for a while and then wonders where it all went. Or you can be the person who looks ordinary for a while and quietly builds something substantial. I chose the second path. It was not glamorous from the outside. It did not make for exciting stories every year. But over a lifetime, it led exactly where I wanted to go. Take your 20,000 or whatever you have. Respect it. Treat it as the seed of your future, not as a scratch ticket. Plant it in real assets. Water it with more savings. Protect it from your own stupidity. Give it 30 years. If you do that, you will not need to ask anyone how money works. You will have your own proof sitting in your account, quietly compounding while the rest of the world continues to chase illusions. Most will not do it. You still can.